Okay, let's cover the important concept of intrinsic value. This is sort of the real value of a company. So what a company is worth based on its profitability, how much money it's making, how much debt it owes, how much asset it owns, etc. So why is this important? Because then you can determine whether a company is cheap or expensive uh, in relation to this intrinsic value, which is a way better valuation criteria than looking at just price earnings ratio, for example. So the simple way to calculate this, there are many complex ways as well, but let's just focus on a simple version where let's say there's a company with an earnings per share of $1.50, and the growth, yeah, you expect the company to grow at let's say 10% a year. Then what you do is you simply take, oh, and the price earnings ratio of this company uh, over the average price earnings ratio for this company is, for example, 12. So if you take the earnings per share of $1.50 and you multiply it by 1.10, which is for the 10% growth, and you sort of try to see what this company should be worth in 5 years. So you to the power of 5, and you multiply this with the PE ratio of 12. And what you end up with is, I'll just quickly take my calculator, $28.98. So you can expect the company to be worth around $29 in 5 years' time. However, you want to know if it is cheap today. Well, let's say at least you want to earn a market return, and the historical stock market return has been around 8-9%. So if we take this $28.98 we got from here, and we divide this by 1.09, which is the average historical return of the stock market, to the fifth, what we get is a current value of $18.84. And this is the intrinsic value of a stock with the following figures. So now all you have to do is compare this with the current stock price. And if the stock price is lower than the intrinsic value, then a stock is cheap. If the price is higher than the intrinsic value, stock is expensive. It is as simple as that.